Okay, let's dive right into this massive $4.29 billion staffing giant, Robert Half, and unpack the shocking paradox that Wall Street seems to be completely ignoring right now. Welcome to today's Explainer, where we are going to tear into the numbers of a company that is somehow flashing brilliant green buy signals and absolutely terrifying red warning lights at the exact same time. Here's how we're going to break this down. First, the Robert Half paradox. Then, 7 glaring red flags followed by 7 hidden green flags. We'll run it all through the legendary investor test and finally give you the final verdict. Section 1, the Robert Half paradox, a $4.29 billion mystery. Let's start with the core financial tug-of-war at the heart of this company. The sheer contradiction here is just staggering. On one hand, you've got a highly alluring 5.53% dividend yield and a massive 24.8% 52-week return. I mean, that looks fantastic, right? But on the flip side, that momentum is fighting against completely collapsing fundamentals. We're talking earnings down nearly 80% and revenue that is actively shrinking. So it really begs the question, is the market pricing in some kind of miraculous turnaround, or is this just a total disaster waiting to happen? Section 2, 7 glaring red flags, the case for the bear. It's time for the prosecution to step up, so let's rapidly fire through the 7 warning signs that make this stock look incredibly dangerous. Right out of the gate, investors are paying a trailing PE of 37.10 times earnings. To put that into perspective, the staffing industry typically trades at, maybe 12 to 18 times earnings. So you are paying more than double the industry average multiple for a business with declining revenue. Add to that red flag 2, a bottom-tier growth rank of just 4 out of 10, plus multiple systemic warning signs indicating some very real challenges with scalability. And that leads right into red flag 3, which is a brutal structural 3-year consecutive decline in revenue. The company has fallen from a $7.24 billion peak in fiscal year 2022 down to $5.8 billion in 2024, and it's projected to sink even further to $5.31 billion by 2026. So let's be clear, this isn't just a cyclical blip, this is a sustained multi-year downward trajectory. That massive number is red flag 4. It represents the catastrophic percentage drop in net income. Back at its peak in 2022, Robert Half was pulling in roughly $658 million in net income. Today, that has crashed down to just about $133 million. That is a nearly 80% collapse in pure profit. It's just brutal. Red flag 5 centers on their consulting segment, Protiviti. Now, this segment makes up about 35% of their total revenue, and its margins are completely collapsing. Gross margins plummeted from 19.7% down to 13.5% year over year. A big chunk of that is driven by $7 million in severance costs tied to some really heavy restructuring. Honestly, given all this, it is no wonder that for red flag 6, 11 Wall Street analysts are overwhelmingly bearish. The consensus is a hold, with an average target about 18% below current prices. But it gets worse. Goldman Sachs and UBS are literally screaming sell, with UBS setting a target of just $20. If that happens, you're looking at a staggering 53% downside. For our final red flag number 7, the contrast is deeply alarming. Their return on invested capital is a paltry 0.58%, while their weighted average cost of capital is 8.02%. Put simply, they are earning way less on their cash than it costs them to fund their operations. They aren't creating shareholder value right now, they are actively destroying it. Section 3, 7 hidden green flags. The case for the bull. Just when you think this thing is totally uninvestable, the defense takes the stand with 7 green flags that completely flip the narrative. Green flags 1 and 2 show a company that is considered significantly undervalued by Guru Focus. Their proprietary GF value estimates intrinsic value at $58.05, meaning the stock is trading at a 26 to 34% discount. Combine that with a massive 5.53% annual dividend yield, and with a payout ratio of about 59%, that dividend is historically well covered. For income seekers, that is highly attractive. Green flag 3 is their moat score. They actually pull a 5 out of 10, which indicates a solid, narrow moat. What this means in plain English is that their brand power and distribution network rank better than nearly 96% of all their business service peers. Having that kind of intense customer loyalty is a massive, massive asset in the highly competitive staffing space. For green flags 4 and 5, we are finally seeing some actual momentum building. Their core talent solutions sector just posted its 3rd consecutive quarter of sequential revenue growth. And get this, permanent placements actually returned to positive year-over-year growth. Meanwhile, management is proving they're shareholder-friendly by aggressively buying back stock, literally reducing the total share count by almost 1.5% over the past year. Green flag number 6 is the bedrock of their bull case. Robert Half is sitting on over $325 million in pure cash and equivalents. Their balance sheet is absolutely bulletproof. The debt-to-equity ratio is 0.20, so practically zero. They are conservatively capitalized and fully ready to weather whatever economic storms come their way. Wrapping up the defense with Green Flag 7, management just issued Q3 guidance that completely beat consensus estimates. They're projecting roughly 3% year-over-year revenue growth in talent solutions. That suggests the bleeding might actually be stopping, and a very real turnaround is brewing right under our noses. Section 4. The Legendary Investor Test. Buffett, Graham, Lynch, and Moat. Let's run all these conflicting data points through 4 legendary investment frameworks and settle the score once and for all. The stark reality becomes pretty clear when you look at these metrics. Benjamin Graham, the literal father of value investing, looks for a PE under 15. Robert Half is at 37.1. He wants price to book under 1.5, they are at 3.56. Sure, it passes his low debt criteria, but it catastrophically fails his valuation rules. Meanwhile, Warren Buffett demands a return on invested capital and return on equity of at least 15%. With an ROIC of less than 1% and ROE of 9%, Buffett would instantly reject the stock. The returns on capital are just fatally low. Moving on to Peter Lynch's growth at a reasonable price or GARP framework. Lynch's golden rule absolutely destroys Robert Half's chances. His framework revolves around the PEG ratio, finding that perfect balance between price and growth. As Lynch famously said, a fairly priced company's PE should equal its growth rate. Well, you simply cannot justify a 37 times PE when your earnings growth is negative 79.8%. It just doesn't compute. So, while the Moat analysis gives it a hesitant nod because of that undeniable brand strength, it also warns that intense competition limits how wide that moat actually is. But when you look at the legendary investor consensus across Graham, Buffett, and Lynch, it is a brutal, unequivocal failure across the board. Section 5, the final verdict. What should you do? Let's synthesize all of this and figure out exactly what it means for your specific portfolio strategy. Ultimately, your strategy is going to dictate your action here. If you're a traditional value investor following Graham or Buffett, this is a hard pass. It looks like a terrifying value trap with deteriorating fundamentals and extreme overvaluation. But if you're an income hunter, you might want to put this on your watch list. That 5.53% yield is highly compelling and currently well covered, though you've got to watch closely to make sure the earnings decline doesn't eventually threaten that payout. And if you're a contrarian, the value metrics suggest there's a serious discount to be had, assuming management's turnaround guidance actually holds water. As Buffett so wisely warns us, price is what you pay, value is what you get. Right now, at roughly $42 a share, you are paying a massive premium for a business with collapsing margins, shrinking revenue, and a dismal sub-1% return on invested capital. So the true paradox of Robert Half remains. It's a high-quality brand with a fortress balance sheet, but its engine is definitely sputtering right now. I'll leave you with this final thought to chew on. Do you grab that juicy 5.5% dividend yield right now and trust the turnaround? Or is the allure of immediate cash simply not worth the risk of catching a falling knife? You'll definitely want to watch their upcoming earnings like a hawk, because that's going to give you your final answer. Thanks for joining me on today's Explainer, and keep learning.